Hi there, and thank you for joining us on the second episode of Stock Market 101 by CM Tribe Learn. In the previous lesson, we explained what the stock market is, why it exists, and how to buy stocks. Please see the description below for the link to episode 1. At the end of this video, you'll know the basics of stock investing, how stocks are analyzed, and how to select the right stocks to invest in, based on your analyses. Let's get to it. The number one principle of stock investing is that you're in it to make profit. This means you're looking to buy the stock at a low price and then sell it at a much higher price. The second is risk. Risk is an unavoidable element of stock investing. Just as the market value of a stock can go up, it can also suddenly drop and cause immense loss. As a stock investor, you must be willing to accommodate a certain degree of risk with every stock that you trade. Every strategy or technique used in stock investing is designed to maximize profit and minimize risk. The third basic of stock investing is time. Investing in stocks means you're willing to wait for the market value to grow and bring in profit. This wait period can vary from a few weeks to a few years. Stock investors are usually in it for the long term. Of course, it's possible to trade stocks short term, but there are much better instruments that can you trade over that same period and make more profits. Examples include Forex, exchange-traded funds, cryptocurrencies, and derivatives. We'll cover these in subsequent lessons. The stock market is governed by the economic laws of demand and supply. If the demand for a stock goes up, its market price goes up as well. This causes sellers to tighten up supply and raise their ask prices to reflect the current market value. Likewise, if there is little demand for a stock, then its price will drop. This means sellers will gladly lower their ask prices in order to quickly offload it and avoid further losses. When you hear bull market, it simply means investors and traders are optimistic about that stock. This makes them buy more shares of the stock, since they expect its value to go up. As more and more buyers enter the market, the stock value keeps rising, resulting in more profits. On the other hand, bear markets indicate negative sentiment about the stock. Investors and traders want to quickly sell off their shares, since they expect the market value to keep going down. It's impossible to time the markets. There are way too many variables at play every second, and the price can change direction at any time. Still, in order to make profit, you need to know the right time to buy or sell stocks. You'll need sort of a roadmap to help you make informed decisions on each trade. This is where stock analysis comes in. Stock analysis simply means due diligence. It's a way of looking at the market to determine what stocks to invest in and when to place your trades. More importantly, it can provide insight into how the market will likely behave in the near future, whether bullish or bearish. For example, if your analysis shows that the value of the stock will soon go up, you buy more now, so you have more shares to sell later. If you expect it to go down, then you sell now, so you don't make any more losses. There are two categories in stock analysis: fundamental and technical analysis. Fundamental analysts believe that the market value of a stock is not defined by its current price alone. So they consider other factors outside of the stock price when deciding whether to buy or sell that stock. The goal here is to assess the business model, financial statements, profit margin, and other key indicators to determine if the stock is overvalued or undervalued compared to intrinsic market value. Intrinsic just means the stock has value in itself. This value can come from the strength of the company, its market leadership, its projected profitability, or even the current state of the economy. If the stock is considered overvalued, then it means the value is expected to go down to its intrinsic market price. So you should look to sell to protect your profits. If undervalued, then the value is expected to rise to match the intrinsic market value. So you should look to buy to maximize profits. Common fundamental analysis indicators include free cash flow, earnings per share, and dividend payout ratio. We'll look at these in more detail in the next lesson. Technical analysts are primarily concerned with price movements on the chart when deciding whether to buy or sell stocks. The goal is to identify market patterns, and use them to predict whether the stock price will go up or down in the near future. If you can properly predict the next price move, whether up or down, then you know whether to buy or sell the stock. If you predict the price will go up, you place a buy order. If down, you place a sell order. Common technical analysis indicators include relative strength index, moving average, and Bollinger Bands. There are 3 types of stock investors. And how you choose which stocks to invest in will depend on what type of investor you are. Income-oriented investors focus on buying stocks from companies that regularly pay good dividends. These companies are in stable industries, such as utilities and real estate. These investors are generally moderate risk takers. Wealth preservation investors look for stocks that can beat inflation rates and provide better returns than bank savings. These are mostly from blue-chip companies, with a proven record in the stock market. These investors have a low tolerance for risk. As such, they hardly ever go for IPOs. Capital appreciation investors go for stocks that are likely to grow profitably. Examples include tech companies and corporations that provide innovative solutions. These investors have a higher risk appetite, so they buy the stocks early and simply wait for it to appreciate in value. It is always best to mix both fundamental and technical analysis when selecting stocks to trade. For example, if you're an income-oriented investor, then you'll conduct fundamental analysis and check the company's dividend payout ratio, or earnings per share, to determine if the stock is worth investing in. If you're a capital appreciation investor, then you can conduct technical analysis to see how fast the stock price is growing and whether there are lots of people investing in it. In the next video, we'll look at fundamental and technical analysis indicators. Understanding chart patterns. Building and diversifying your portfolio, and stock trading strategies. Don't forget to like and subscribe to stay up to date on all our lessons. If you got any questions, please feel free to ask them in the comments section below. See you there.